Ladies and gentlemen, welcome back to Asian Guy Analysis on 24 January 2026. While everyone's watching crypto and stocks, the smartest money in the world is quietly doing something else, buying physical gold and silver like there's no tomorrow. And what they know might change how you think about protecting your wealth. I'm talking about central banks, sovereign wealth funds, and billionaire investors who manage trillions of dollars. These aren't amateur investors. They're the institutions that literally move markets. And right now, they're all making the same move. Let me show you exactly what's happening and why it matters to you. Let's start with the facts. In 2023, central banks purchased over 1,000 metric tons of gold, the second highest annual purchase on record. The People's Bank of China, the Reserve Bank of India, and the Polish National Bank are leading this charge. But here's what's really interesting. They're not buying gold ETFs or paper gold. They're demanding physical bars, the kind you can stack in a vault. Why does that distinction matter? Because paper gold is a promise. Physical gold is actual wealth you can hold. And it's not just gold. Silver demand hit a record high, with industrial applications combining with investment demand, creating a supply crunch that has experts concerned. So why is this happening right now? 3 major reasons. First, currency concerns. With the US national debt exceeding $36 trillion and growing, many nations are worried about the long-term stability of the dollar. Gold doesn't have a debt crisis. It can't be printed into inflation. Second, geopolitical tensions. After the US froze Russia's dollar reserves in 2022, many countries realized that foreign currency reserves can be weaponized. Gold stored in your own vaults, that's truly sovereign wealth that no one can freeze or sanction. Third, economic uncertainty. We're seeing banking system stress, inflation concerns, and potential recession fears all happening simultaneously. Throughout history, precious metals have been the ultimate insurance policy during uncertain times. Let's talk about who exactly is stacking physical metals. Central banks are leading the charge. China has been buying gold every single month, adding to reserves consistently. They're diversifying away from dollars strategically and systematically. Billionaire investors like Ray Dalio of Bridgewater Associates has publicly stated that investors should hold 5 to 10% of their portfolio in gold. Stanley Druckenmiller has also positioned heavily in precious metals. Sovereign wealth funds from the Middle East and Asian investment vehicles are allocating more to physical metals than ever before. These aren't retail investors panicking. These are the most sophisticated financial minds in the world making calculated moves. Now, let's talk about silver for a moment, because this might be even more interesting than gold. Silver has a unique dual role. It's both a monetary metal and an industrial metal. With the green energy transition, solar panel production requires significant amounts of silver. Electric vehicles use silver. 5G technology uses silver. Here's something most people don't realize. A single solar panel contains about 20 grams of silver. As the world races toward renewable energy targets, the demand for silver in solar panels alone could consume a massive portion of annual mining supply. Electric vehicles use roughly twice as much silver as traditional combustion engine cars. Every 5G cell tower requires significantly more silver than 4G infrastructure. The Silver Institute reports that industrial demand is outpacing mining supply. Unlike gold, which is mostly recycled and stored, silver gets consumed in industrial applications. This creates a fundamentally different supply-demand equation. When you use silver in electronics, solar panels, or medical applications, it's gone. It's not economically viable to recover it. Gold, on the other hand, almost never gets consumed. It gets recycled, melted down, and reused. This means that thousands of years of gold mining still exists above ground. But silver? It's being consumed faster than we're mining it. Some analysts believe silver is more undervalued relative to gold than at almost any point in history. The historical gold to silver ratio averaged around 15 to 1 for centuries. Right now, it's hovering around 85 to 1. That means gold is 85 times more expensive than silver per ounce. Whether that ratio reverts to historical norms is debatable, but it's certainly caught the attention of sophisticated investors. So what does all this mean for you as an individual investor? You don't need to be a central bank to think like one. The same reasoning that drives institutional buying can apply to personal portfolios. Diversification beyond paper assets is crucial. Stocks, bonds, and cash are all vulnerable to the same systemic risks. Physical metals provide diversification that's truly uncorrelated. Think about what happened in 2008. Stocks crashed, real estate crashed, many bonds were in trouble. What held its value? Gold actually increased during the financial crisis. That was what true diversification looks like, having assets that don't all move in the same direction when markets get turbulent. Inflation protection matters. While the Fed targets 2% inflation, real-world costs for housing, food, and energy have risen much faster. Precious metals historically maintain purchasing power over long periods. Let me give you a concrete example. No counterparty risk is a huge advantage. Physical gold and silver in your possession don't depend on any bank, government, or institution remaining solvent. This is worth emphasizing. When you own a stock, you're depending on that company staying in business. When you own a bond, you're depending on the issuer paying you back. When you have money in a bank, you're depending on that bank remaining solvent. But when you hold physical gold or silver in your hand, you're not depending on anyone. That's true financial independence. Financial advisors traditionally recommended 5 to 10% portfolio allocation to precious metals. Given current conditions, many are revisiting whether that should be higher. Now, I know what some of you are thinking. Doesn't gold just sit there? It doesn't produce income like stocks or bonds. That's absolutely true. Gold and silver are insurance, not growth investments. You're not buying them to get rich. You're buying them to stay wealthy when other assets are under stress. Think of it like homeowners insurance. You don't buy insurance hoping your house burns down. You buy it so that if something goes wrong, you're protected. Warren Buffett famously criticized gold because it doesn't produce anything. And he's right. From a pure productivity standpoint, gold just sits there. But Buffett is one of the greatest investors during one of the most stable and prosperous periods in American history. Not everyone has that luxury of perfect timing and stable conditions. The world's biggest money isn't buying precious metals because they think they'll 10x. They're buying because they understand that preserving wealth is just as important as growing it. There's an old saying among the truly wealthy. The first rule of money is, don't lose it. The second rule is, remember the first rule. Precious metals are about that first rule. They're about making sure that no matter what happens in markets, politics, or the global economy, you still have wealth that maintains its value. If you're interested in following this trend, here are some practical considerations. For physical metals, buy from reputable dealers with transparent pricing, do your research on dealers, check reviews, verify they're members of industry associations like the Professional Numismatists Guild or the American Numismatic Association. Compare prices across multiple dealers because premiums can vary significantly. Consider storage carefully. Home safes, bank safety deposit boxes, or allocated storage. Each option has trade-offs. Home storage gives you immediate access, but comes with security concerns. Bank safety deposit boxes are secure, but you don't have access during bank holidays or emergencies. Allocated storage with specialized firms offers security and insurance, but adds ongoing costs. Understand the difference between bullion and numismatic coins. Bullion coins like American Eagles or Canadian Maple Leafs trade based on their metal content, plus a small premium. Numismatic or collectible coins can carry much higher premiums based on rarity, condition, and collector demand. For most investors, bullion is the way to go. Start small and dollar cost average rather than trying to time the market. Maybe you commit to buying 1 ounce of silver every month or a 1/10 ounce of gold every quarter. This approach removes the stress of trying to time the perfect entry point and builds your position gradually over time. For exposure without physical ownership, look into physically backed ETFs, though understand these still carry some counterparty risk. ETFs like GLD or SLV provide exposure to metal prices without the hassle of physical storage. But remember, you're holding shares of a fund, not actual metal. There's still an institution between you and the underlying asset. Research mining stocks if you want leverage to metal prices. When gold prices rise, mining company profits can rise much faster because their production costs stay relatively fixed. But this cuts both ways. Mining stocks are more volatile and come with company-specific risks like management quality, mining accidents, or geopolitical issues in where they operate. Most importantly, do your own research, understand what you're buying, and never invest more than you can afford to keep tied up for the long term. Precious metals aren't get-rich-quick schemes. They're long-term holds. You might buy gold today and not see significant price appreciation for years, but that's not really the point. You're holding it for the day when everything else is in trouble. The world's biggest money is making a clear statement with their actions. Physical precious metals matter in an uncertain world. Central banks buying thousands of tons of gold, sovereign wealth funds diversifying into silver, billionaire investors allocating significant portions of their wealth. This isn't random. They're reading the same economic headlines we are, but they're positioned to act on institutional scale. The good news? The same reasoning that drives their decisions can inform yours. You might not be able to buy a ton of gold like a central bank, but you can apply the same strategic thinking. You can recognize that diversification matters. You can understand that counterparty risk is real. You can appreciate that preserving wealth is just as important as growing it. This isn't financial advice. I'm not a financial advisor. But it is information worth considering as you think about protecting and growing your wealth in 2025 and beyond. The financial landscape is changing. The rules that worked for the past 40 years might not work for the next 40. The institutions that have successfully navigated markets for decades or even centuries are adjusting their strategies. Maybe it's time for individual investors to do the same. What do you think about the precious metals trend? Are you considering adding gold or silver to your portfolio? Let me know in the comments below. And if you found this analysis helpful, hit that subscribe button. We break down complex financial topics just like this every week. Thanks for watching, and I'll see you in the next one. Claude is AI and can make mistakes. Please double-check responses.